Every year, retirement planning changes and evolves just a bit, either through something as simple as inflation adjustments to something as big as tax law changes. In today's video, we're going to talk about 7 changes to retirement planning in 2024. Let's get into it. Over the past 4 years, one of the biggest fears and trends in retirement planning has been rising inflation. Since 2020, we've seen inflation average nearly 4.5% for a total increase of 19.2%. For someone sitting planning retirement in 2019, this is likely way ahead of expectations. In general, inflation is not a good thing. Yes, there are healthy levels of inflation, but 4.5% per year is a bit beyond healthy levels. Many assets are hurt by rising inflation. Fixed income over this period has been hurt greatly, down nearly 20% after inflation. Stocks tend to overcome inflation over the long term, but certainly can be hurt in the short term. But inflation affects far more in retirement planning than just your portfolio, and there are some minor silver linings. Tax brackets adjust to inflation annually, which will give you more room to fill up each bracket. Since 2020, most tax brackets have adjusted in the mid 17% range. Now, this is slightly off the inflation data that I showed earlier, but keep in mind these tax brackets aren't adjusted annually from January to December, but rather from September to August. And so there's going to be some small adjustment just based on when they calculate and gauge that inflation adjustment. Now, not only do we see ordinary income brackets adjusted, but we also see the standard deduction and long-term capital gain brackets adjusted here as well at a similar pace. We focus on a married filer situation. I just want to note the amount of space a retiree has in the 0% long-term capital gain bracket. Adding in the standard deduction, a couple can show over $120,000 of taxable income and still be in the 0% capital gain bracket. And it's worth noting that inflation affects everyone differently. It's a general measure. Your personal inflation rate might be less. Retirees' inflation rates usually are less because their spending tends to drop over time. If your inflation rate has been lower than 17% over the last 4 years, well, you've actually gotten slight benefits from inflation because you are able to work the tax brackets in your favor a little bit better. However, taxes have grown as an expense if your inflation rate has been higher than the general measure. This inflation has been generally good for things like Roth conversions over the past 4 years. With a slowdown in inflation-adjusted portfolio performance and a bear market in there, many retirees have been able to get ahead on Roth conversion timelines during this inflationary period of time and done so at more favorable tax brackets that we'll talk about a little bit later in this presentation. Then outside of this, know that inflation has been slowing down. The last 12 months have shown inflation down to 3.4%, and it looks to be continuing to trend downward. Beyond this, inflation has raised the contribution limits for savers. Across the board, many contribution limits have been in line with keeping up with inflation, allowing you to save a bit extra in your final years of working. Then finally, it's important to note that a big retirement asset, Social Security, has been an asset that does offer some inflation protections. Since 2020, we've seen an 18.7% increase in benefit values. This is across the board and in addition to any step-ups that you receive from delaying. Now, inflation isn't the only big change to consider as we move into 2024. For those that are younger than 65, there are some big changes ahead for healthcare planning coming down the pipe. For a bit of background on the Affordable Care Act marketplace, the amount that you pay for health insurance is directly tied to your reported income. In many ways, a retiree can take from assets like a Roth account or taxable account and artificially keep their reported income down, thus earning a very large subsidy and earning affordable insurance. Prior to 2020, there was a subsidy cliff. When an individual crossed a certain level of reported income, their costs as a percentage of their reported income would more than double just for falling off that subsidy cliff. Now, the CARES Act of 2020 and the Inflation Reduction Act of 2022 changed the subsidy cliff into more of a subsidy slope, where costs increase linearly beyond that subsidy cliff point. This makes healthcare with higher income much more affordable for retirees. The problem is the subsidy slope ends in 2025, and come 2026, we'll go back to that subsidy cliff. So retirees that will be younger than 65 through this phase should 100% be using the current system to their advantage and prepare for reporting lower incomes come 2026. This is critical in planning here in 2024. Number 4, one of the most confusing areas of planning in the past 4 years has come in the inherited IRA realm. If you inherited an IRA post-2020, things have been quite complex over the last few years. Originally, when the Secure Act was set up in 2020, the rules were relatively simple. If you inherited an IRA, let's say from a parent, you had 10 years to fully withdraw the balance from that IRA. You didn't need to take an annual RMD any of the given 10 years, just exhaust that full account by year 10. Simple enough. Since then, Congress has changed its mind multiple times. In 2022, as part of Secure Act 2.0, Congress updated the rules to now say that if the person that passed away was currently taking RMDs, then the beneficiary of the inherited IRA would need to take an annual RMD each of the 10 years and then also have that account exhausted by that 10-year mark. Now, I'll link to a video here that explains this a little bit more in depth. But despite this rule change in 2022, the government updated this rule saying that you actually didn't need to take an RMD from those inherited accounts in 2022. Then they said you didn't need to take one in 2023 either. As far as we know right now, you will need to take one now in 2024. But as we've seen before, this may change. But right now, plan on an inherited IRA RMD this year. Number 5, another window of opportunity that is closing fast is the current Tax Cuts and Jobs Act tax system. The Tax Cuts and Jobs Act was put into law in 2018 and is set to expire here in 2025. For most retirees, these tax cuts are a huge opportunity. Come 2026, the standard deduction is set to fall, and each tax bracket will revert to the older, higher rates that we saw before. This is unless Congress steps in and extends these cuts or changes to a new system altogether. As you can see from the brackets on the screen, each bracket rises 0 to as much as 4%. But big picture, this might seem like small potatoes. What difference could a 2% increase in a given tax bracket actually have? Well, for retirees, the difference can actually be quite substantial. Last year, I did a case study looking at 3 different retirement situations and compared 2023 taxes to an estimate for 2026 taxes. Across the board, we saw double-digit increases in the underlying tax bill. And so we see those small differences can really add up. And so again, for a retiree that is looking to optimize their tax situation, we need to be using the current tax system available to us to minimize these future tax increases. Number 6, this will be the first year we see the RMD starting age change from 72 to 73. Those born in 1951 will be turning 73 this year and must begin those required minimum distributions from their tax-deferred accounts, like traditional IRAs, 401ks, 403bs, TSPs, SEP plans, and more. 73 will remain the RMD age until 2035, when the RMD age will update to 75. Now, just as a reminder for those that are 63 this year, you have the ability to take your RMD anytime this year in 2024, and then all the way into April 1st of 2025. A visual example is shown on the screen. Now, even though you have extra time, I would caution against waiting until 2025 outside of maybe specific situations. The reason is that if you wait until 2025 to take that first RMD, you will have to turn around and take another RMD that year for 2025 as well. So 2025 could turn into a double RMD year as you take 2024's RMD and then 2025's. This can make sense, again, in a few specific situations, but most will find that taking their RMD this year will be the wisest. Then finally, the last change here for 2024 is the ability to do a 529 to Roth IRA rollover. This is now a viable strategy here in 2024. This can be a great escape hatch for those that oversaved into their 529 plans for themselves or for their children. Here are some rules to be eligible for this rollover. This rollover must happen to the same beneficiary, which means if you're going to roll over from John's 529 plan, it needs to go into John's Roth. You can't go from John's 529 plan to Cindy's Roth. Your annual limit is the Roth contribution limit, and every rollover dollar that you take will eliminate the room you have for a contribution dollar and vice versa. The 529 plan must also be established for at least 15 years, and the lifetime maximum for this rollover is just $35,000. Now, the biggest benefit within these rules is that there's no income limit like Roth contributions have. If you make too much, you may not be able to do a Roth contribution, but again, there's no income limit for a 529 to Roth rollover. This makes it possible for a high earner to still contribute to Roth via this rollover strategy. Again, this is available starting here in 2024. And so a lot of changes have come to retirement planning in 2024. Some were big changes, some much smaller. One of the more important changes is the inevitability of the tax laws changing. In this video right here, I talk about all the tax changes coming to 2026 and expand quite a bit more than I did in this video. Click here to learn more, and always remember, you don't need more money. You need a better plan. Thanks for watching. I'll see you in the next video.